Hello everyone, welcome to Swayam BHU course on Fundamentals of Economics and Financial Markets. Myself Dr. Anand Singh, and today in this video I will be discussing regarding the details of money market. Now this particular topic, that means money market, will be covered by me under 8 major key points. Now those key points are: point number 1, what is the meaning of money market? In the first segment, we will discuss regarding the meaning and important features of money market. In the second segment, we will discuss regarding what are the important features of a developed money market. That means, in order to be regarded a developed money market, what are the key features, what are the important characteristics which must be seen in any market or which must be seen in any money market. In the third segment, we will discuss in detail about the features of Indian money market. That means what are the features which are basically associated with our money market, that is Indian money market. Now in the fourth segment, we will basically discuss regarding the various components of Indian money market. That means on what segments, on what components, on what basis our Indian money market may be broadly classified into, or it may be divided into. Now in the fifth segment, we will discuss regarding the meaning and features of organized sector. That means what is the meaning of organized sector? In the sixth segment, we will basically discuss regarding some of the major participants of the organized sector of our Indian money market. In the seventh part, or in the seventh key point, we will basically discuss regarding the meaning of unorganized sector. That means what is the meaning of unorganized sector of our Indian money market. And at the end of this particular video, or in the 8th key point, we will basically discuss regarding some of the major participants of unorganized sector of Indian money market. So let us start this video. Now the first point of discussion, that what is the meaning of money market? As it is already discussed by me in the earlier video also, money market is basically that market, or it is basically that segment of the financial market which deals with the short-term securities which are having a maturity period of less than 1 year period. That means all the instruments, all the securities, or all the financial assets which are traded under money market, they are having a maturity period of less than 1 year period. That means the investor, whosoever is investing in the money market, he will be entitled to get his money back or get his investments back in the form of principal and in the form of interest thereupon. That means both the amount will be get matured. That means his principal investment and the interest thereupon, both the value will get matured at the end of or within a period of 1 year period. Now earlier also I had discussed in detail that this definition is basically conceptual in nature, because in practicality, in reality, there are large number of instruments in our money market also which are having a maturity period of more than 1 year period. But earlier also I had said clearly that all those instruments are basically exceptional in nature. In theoretical point of view, or in theory, we basically define our money market in the form or in a way that money market is that market where all the securities, or where such kind of securities are traded which are having a maturity period of less than 1 year period. Now, what is the importance of money market? Money market is extremely important for the big organizations, or for any kind of organizations, for the government, for the companies, for the institutions, etc., in order to avail the short-term funds, in order to maintain their liquidity position, in order to get the short-term funds requirement. All such kind of institutions, the government or any other organization, it basically looks after or it basically enters the money market. Why? Because it deals with short terms. So it basically provides such kind of securities which, or from where the companies can raise their short-term fundings. Now, the money market is also regarded as it is less risky as compared to the capital markets, because it deals with the short-term securities. So the nature of those securities are quite less risky as compared to the securities which are traded in the capital markets. Now, let us discuss regarding the second point, that what are the important features of a developed money market. That means what are the important features or what are the important characteristics which must be seen in any money market which is basically regarded as a developed money market. Some of the important points are: number one, there must be a presence of a central bank. Why? Because it is assumed that most of the money markets which are found throughout the globe, in any country, in most of the developed countries, there exists a central bank. There exists a bank which basically supervises the activities of that particular money market. For example, in India, whether there is any central bank or not, yes, RBI is there. And we know that RBI is basically the regulatory body for all the banking system as well as the money market of India. In the same manner, if you will talk regarding the USA market, then Fed Reserve is there. Now the Fed Reserve, which is also their central bank, it is basically the regulatory body for their money market. In the same manner, if you will talk regarding the UK, United Kingdom, then there also Bank of England is there. That is the central bank of United Kingdom, and that is basically the regulatory body for their money market. So the point number one, or the most important feature, is there must be a presence of a central bank. Now the second point is, or the second important feature is, that market must be highly organized. Now, in order to be regarded as a developed money market, that money market must be properly organized. Organized means that must be prescribed by certain rules and regulations. All the components or majority of the components of that money market must be properly regulated. They must be properly supervised by the regulatory bodies. So if a money market is there where the majority of the segments or the majority of the participants, they are properly regulated, they are well supervised by the regulatory bodies, then it is a properly organized market. Now the third important feature, which is essentially required to be regarded as a developed money market, is availability of large number of instruments. That means in that particular market, the number of instruments, it must be very large. Large number of financial instruments or large number of financial assets or large number of financial securities must be traded in that particular market. If the number of instruments is less, if the number of securities traded over those markets is less, then that market can't be regarded as a developed market. In order to be regarded as a developed market, the number of instruments, it must be very, very large. We are not discussing regarding the volume of funds. We are discussing regarding the number of instruments. That means the investors must be having an opportunity, that they are getting an opportunity to make investments in large number of alternatives. And it is very clear that since we are discussing regarding money market, so all those instruments are basically of short-term nature. They must be having a maturity period of less than 1 year. Now, the fourth important feature is there must be proper control over the rate of interest. The rate of interest which is prevailing over all the instruments which are traded under that money market, there should not be huge fluctuations in the rate of interest over such kind of instruments. Now, in organized markets or in developed money market, it is seen that the number of instruments are very large, but the rate of interest which is applicable upon those instruments, that is not highly fluctuating. The rate of interest is very less, or there is less difference between the rate of interest between two or more instruments. Those are not highly volatile in nature. Now the sixth important feature is the existence of discount houses. Now discount houses plays an extremely important role in the field of money market. Why? Because they provides liquidity to the market. They are always ready to discount the short-term instruments. They are always ready to discount and to provide liquidity to the market. So large number of discount houses, if they are available in any market, then that market may be regarded as a developed money market. 8th point is adequate supply of funds throughout the year. In that particular market, the volume of funds, that must be huge. At the same time, it must be available throughout the year. It should not be based on seasonal terms. The funds should be available throughout the years. If the funds are available throughout the years, then that market may be regarded as a developed money market. And the last important feature is there must be proper coordination between all the segments of the money market. There must be proper coordination between all the commercial banks of that market. There must be proper coordination between the banks and other segments with the capital market of that particular country. So if there is coordination between the money market and capital market and all other intermediaries, then that market might be regarded as a developed money market. Now let us move to the next important key point, that is, what are the important features of Indian money market. Now when we will see our Indian money market, then some of the important features are: point number one, here short-term funds are traded. That means maximum securities, the most of the securities or most of the financial assets which are traded in our money market, they are having a short-term maturity period. That means most of the securities, they gets matured within a period of 1 year. Only few securities are having a maturity period of more than 1 year, and that's why those securities are basically regarded as exceptional in nature. Otherwise, most of the securities, they are having a maturity period of less than 1 year period. Second important feature is presence of RBI as the central, or presence of RBI central bank as the main regulatory body of our money market. RBI is there. It is the supervisory body of our money market. Now, the third important feature which is directly concerned with Indian money market is it is dichotomy in nature. It is said that Indian money market is basically dichotomy in nature. Now, what is the literal meaning of dichotomy? Dichotomy is basically used for those words which are having a dual meaning or dual nature. Dichotomy basically indicates our Indian money market is that market which is basically having two important segments, that is, one segment is organized and another segment is unorganized. Now, the organized sector is 100% or it is more or less 100% controlled by the regulatory bodies, whereas there is one segment that is unorganized, and it is said that it is more or less, it is free from any kind of rules and regulations. So Indian money market is basically divided into organized and unorganized sector, and organized sector is well regulated, whereas unorganized sector is not regulated at all. That's why overall the market is said to be dichotomy in nature or dual characteristics in nature. Now the fourth point is dominance of money lenders. In a country like India, it is said that almost 70% of the money market is captured by the money lenders, which basically comes under the unorganized sector. But it is one of the most important, or it is one of the negative points which is concerned with our Indian money market, that it is dominated by the money lenders. We can find the money lenders in every small city, in every small village, even in the streets. In every streets, you are going to find money lenders who basically deals in the business of lending money. Now, since they are dominating over the market, or their segment or their portion is almost 60 to 70% of our entire money market, so it is not a very good sign for Indian money market. Now, the next point is point number 5, huge fluctuations in the rate of interest in over the securities which are traded in Indian money market. In Indian money market, we can see that the instruments which are traded under the organized sectors, for example, suppose FD is there, or current account is there, or you can see commercial papers are there, certificate of deposits are there, they are carrying a rate of interest which is nearly, or which is basically fluctuating in a specific range. It might be from 5% to less than 20% or so on. But there is another segment which is unorganized sector. Suppose money lenders, they are lending the money which carries basically rate of interest of more than 40%, more than 30%. And the calculations of those rate of interest is also not on yearly basis. It is basically, it might be calculated on day basis, it might be calculated on a week basis or month basis. So there is a huge fluctuations in the rate of interest over the securities which are traded in our Indian money market. It is also not a good sign. The rate of fluctuation should be uniform, or it will not be very volatile in nature. But it is seen that in Indian money market, the interest rates which are applicable over the instruments which are traded in money market, it is highly volatile. High fluctuations can be seen. Now, the next point number 6 or feature number 6 is lack of organized bill market. Here in our Indian money market, we can see that the bills market are not very organized, because in a country like India, we are basically most of the traders, they basically deals in cash. They do not want to trade on credit terms, so they used to avoid bills. In a country like India, bill market is not well developed, but it can be developed, or it is, or well developed bill market can be seen in the developed countries, but it is not present. Although it is good, bill market is also good in our country, but that is not highly developed. Now, the next point is paucity of funds. We can see that in Indian money market, there is always paucity of funds or lack of funds, because one of the major factor which is basically concerned for this particular point is majority of the population of our country, they are dependent upon agriculture. It is said that 60% or more than 60% or 60 to 70% of the Indians, they are basically dependent upon agriculture, and we know that agriculture is seasonal in nature. You can't get regular income from the agriculture, and since most of the Indians are dependent upon agriculture, so there is paucity of funds throughout the year. Throughout the year, we can't find huge volume of funds in the entire money market. It is basically seasonal in nature. That's why it is said that Indian money markets lacks funds, or they are suffering, or they are basically going or passing through the paucity of funds. Now, the next point is, one of the most important feature is, here there are very less discount houses. In a country like India, or there is huge, or the size of the Indian money market is very huge, but if we see the number of discount houses, then there are very less discount houses in our country. Now, in order to mention a discount house, there is only, or you can say one house is there, DFHI, Discount and Finance House of India, and that was also established in the year 1988. Now, besides DFHI, only the commercial banks, the scheduled commercial banks, you can find the scheduled commercial banks are discounting the bills which are floated by the traders. So, besides the commercial banks, there is only one discount houses, that is DFHI, and rest there are no discount houses which are basically operating in our country. Now, the point number 9 or feature number 9 of Indian money market is less financial instruments are traded as compared, when we will compare our Indian money market with the rest of the Indian rest of the world's developed money market, then the number of instruments which are traded in Indian money market is quite less as compared to the money market of the developed countries. Now, the last feature of Indian money market is there is strong network of banking companies in our Indian money market. Here there are large number of commercial banks, and they are scattered throughout the countries, and they provide the services. They are directly participating in the instruments which are basically a part of Indian money market. Now let us move to the next component, fourth component, and that is what are the major segments of Indian money market. Now, when we will divide our Indian money market, then Indian money market may be broadly classified under three major components on the basis of, number one, on the basis of who are the participants in the money market. That means who are the individuals who are participating in the Indian money market. Then point number two, that what are the different sectors which are basically participating in our Indian money market. And point number third is, what are the different sub-markets of Indian money market. So, Indian money market may be broadly classified under three major categories on the basis of point number one, the participants, the individuals who are participating in our Indian money market. Number two, the sectors which are operating in our Indian money market. And third, the various sub-markets which are actively participating in our Indian money market. Now, the point number one, on the basis of individuals who are participating in our Indian money market, the whole money market may be broadly classified under two major components, that is, number one, debtors, and number two is creditors. Why? Because we know that all the persons, all the individuals who are participating or who are basically dealing in short-term lending or short-term borrowing, that means they are either lending or they are borrowing money for a period of less than 1 year. They are either regarded as debtor or they are regarded as debtors. So all the individuals who are participating in Indian money market, since money market is also dealing with the short-term securities and the maturity period of those securities is less than 1 year. So all those participants may be either regarded as a debtor or creditor. Now, the second major component is what are the different kinds of sectors which are basically under our money market. Now, on the basis of sectors, the entire Indian money market may be broadly classified under two major sectors. One sector is organized sector, second sector is unorganized sectors. Now, let us discuss regarding what is the meaning of an organized sector. Now, organized sectors are all those sectors which are basically regulated by certain rules and regulations. They are properly supervised by certain regulatory bodies. There are certain regulatory bodies who supervise the functioning of all the participants in the organized sector. Now, let us discuss regarding some of the major participants in the organized sector. Now, in the Indian money market, some of the major participants under the organized sectors are: number one, the Reserve Bank of India; number two, the scheduled commercial banks, SCBs are there; number third is DFIs are there, development financial institutions; number four, cooperatives are there. Now, it is one point is very clear here, that since all these things, that means RBIs, scheduled commercial banks, DFIs or cooperatives are there, then all these four components, since they are participant of the organized sector, that means they are properly recognized bodies. They are properly operating as per the proper rules and regulations. Now, let us discuss regarding all these points in detail. Point number one, RBI, Reserve Bank of India. All of us knows that RBI came into operation, or it started operating from the year 1935, because RBI Act 1934 was passed by the government. It was passed by our parliament on the recommendation of John Hilton Young Commission. Now, that particular commission was also popularly known as Royal Commission. Now, on the recommendation of Royal Commission, or on the recommendation of John Hilton Young Commission, RBI Act 1934 was passed, and just after passing that particular act, RBI became the major regulatory body of our financial system, especially of the money markets and the banking sector. Now, RBI, soon after its establishment, it was having certain features, or it was having certain autonomies. Regarding what? Point number one, it was having autonomy to issue currencies in our country, or currencies notes in our countries. Now, it acts as the agent of our central government, or it as the agent of our state governments. Now, RBI is also responsible to control the inflationary pressures in our country. Why? By monitoring the monetary policies. It used to frame the monetary policies in our country. And last one, RBI is also responsible to maintain the India foreign exchange reserves. Now, the second major component of the organized sector, that was scheduled commercial banks. Now, let us discuss why they are known as scheduled commercial banks. Because there are certain banks, or there are certain banking companies which have been entered, that means their name has been entered in the second schedule of RBI Act 1934. Now, all those banks or all those banking companies whose name has been entered in the second schedule of RBI Act 1934, they are known as scheduled commercial banks. Now, there are certain parameters after fulfilling which the name of any banking company may be entered in the second schedule of RBI Act 1934. But one thing is clear, after entering in the second schedule, after entering the name in the second schedule, all those banking companies, they are permitted to operate as banking company. They can provide the services of banking. Which banking? that banking which is defined under Section 5B of Banking Regulation Act 1949. So those banking companies are permitted to carry out the operations of banking in our country. Now, what are those three conditions which must be fulfilled by any particular organization in order to get itself names registered in the second schedule of RBI Act 1934? Those three conditions are: number one, the paid up capital and reserves of that particular body or organization should not be less than rupees 5 lakh rupees. That means the paid up capital and reserve of that particular organization must be more than 5 lakh rupees. Paid up capital plus reserves, the combined value should not be less than rupees 5 lakh. Point number two is, it must ensure RBI in writing. That means that particular organization must give in writing, a statement should be given by that particular body in writing that its activity will be in the favor of general public, or its activity will be in the favor of general depositors of the banking companies. And point number third, or criteria number third, is duly approved by RBI or the central government. So in order to be regarded as a scheduled commercial banks, the name of that particular organization should be entered in the second schedule of RBI Act 1934, and in order to be listed under the second schedule, the organization has to fulfill three conditions. Point number one, its paid up capital and reserves should be less than rupees 5 lakh, or it should not be less than 5 lakh. Point number two, it must ensure in writing to the RBI that its working will be in the favor of the general depositors. And point number third, it must be a recognized body by RBI. Now, let us discuss regarding the concept of DFIs. The DFIs are basically the development financial institutions. Now, DFIs are those kind of financial institutions which are established by the government or any other statutory body for the specific development or for the development of specific sectors only. Now, after hearing the name of such kind of DFIs, you can easily recognize the specific sector for the development of which that particular DFI was developed. Merely by knowing the name of that particular DFI, you can recognize the specific sector for the development of which it was basically established. Now, some of the important DFIs which were established in our countries are: point number one, IFCI, Industrial Financial Corporation of India. Industrial Finance Corporation of India. It was established in the year 1948 by the government. It was basically a statutory body. Now, merely by knowing the name IFCI, Industrial Finance Corporation of India, it is clear that the basic objective behind establishment of this body was to provide financial assistance to the corporates, to provide financial assistance to the companies. Now, the second one is TFCI, Tourism Finance Corporation of India. It was established in 1989. Now, by merely hearing the name of this particular body, we can say that TFCI was established so as to provide financial support, to provide financial assistance to the tourism finance or for the promotion and development of tourism in our country. In the same manner, IDBI is there, Industrial Development Bank of India. It was established in the year 1964. Now, government established IDBI. It was also basically a statutory body, and its basic objective was to provide financial assistance for the industrial development of the companies in our country. Now, similarly, there are few other DFIs such as NABARD is there, Exim Bank is there, SIDBI is there. NABARD, National Bank for Agriculture and Rural Development. Now, by hearing the name, we can say that this particular DFI was established to provide financial assistance for the development of agriculture and for the development of rural sector. In the same manner, Exim Bank was established in 1982, and the basic objective was to provide financial assistance to all those companies who are basically dealing in the business of export and import. Similarly, SIDBI was established in 1990, Small Industries Development Bank of India. It was established in 1990, and its basic objective was to provide financial assistance especially to the small industries. Now, the last segment of in this particular organized sector, that is cooperatives. Now, cooperatives are basically the voluntary association of persons who have joined together to promote their common interest related to economic, social and education. Now, they are also registered bodies. They are properly registered under Cooperative Society Act. For the first time, the Government of India passed Cooperative Society Act in the 1904. But after several amendments, nowadays also cooperatives are basically registered bodies under the Cooperative Societies Act. Some of the important features of cooperatives are, number one, all the members, they are having a single voting right. All the persons, all the members of the cooperatives, they are having single voting right, and there is no provision of special voting right. Now, next important feature of the cooperative is it acquires the status of a statutory body. Since it is a registered body, so it acquires the status of statutory bodies. That means they are having a separate legal entity. Also, limits may be prescribed upon the granting or distribution of maximum amount of dividends to the members, as well as maximum amount of holdings by the members in a cooperative. But what is important, cooperatives are a part of organized sector because they are also registered body. They are properly registered as per the Cooperative Society Act. And in the last segment, we will discuss regarding unorganized sector. These are basically those sectors which are more or less free from any kind of rules or regulations. That means there is no regulatory body who is going to supervise the activities of the participants in this particular sector. Now, in the Indian money market, especially in the unorganized sector, there are two major participants, and those are money lenders and indigenous bankers. Now, here it is, one thing is very clear. Money lenders and indigenous bankers, they might be regulated by other laws. That means they comes under IPC. But in the money market, there is not any regulatory body which is going to supervise the activities, which is going to supervise the functioning of these bodies. There is no rules and regulations in order to supervise the activities of money lenders. Yes, there are certain rules and regulations which are developed by RBI from time to time in order to regulate the activities of indigenous bankers. There are certain rules, but more or less both these components, that means money lenders and indigenous bankers, they are a part of unorganized sectors. Now let us have a look between the differences between indigenous bankers and money lenders. Now the key points of differences are, point number one, in case of indigenous bankers, they are basically the high net worth individuals. They are not normal persons. They are having a high net worth. But when you will compare with them the money lenders are basically the small persons, the persons who are dealing in or who are basically dealing in the lending and borrowing or lending of money in a very small volume. Now, the second point of difference is area of operation. When we will you will discuss regarding indigenous bankers, then their area of operation is very large. It might be from 2 districts or more than 2 districts. That means they are borrowing and lending money. They are lending their money in a very huge place, or it might be the area of operation is basically confined to 2 or more districts. But when you will discuss regarding the money lenders, then their area of operation is very small. It might be from 1 village or 2 village or more, or it might be confined to 1 street or 2 street, hardly 1 street or 2 street. Now, the third point of difference is, what about collaterals? Now, in the case of indigenous bankers, they are going to grant loans only after accepting the collaterals. That means collateral is an essential requirement in the case of indigenous bankers. While in the case of money lenders, they might take collateral, they might not take collateral. It is not a compulsory requirement. But in the case of indigenous bankers, the indigenous bankers basically they accept the collateral. After accepting collateral, they are going to grant loans. And the last point of difference is what about recording of transactions in the indigenous bankers, or basically when we will talk regarding indigenous bankers, they record each and every transaction in the most systematic manner, just like the modern commercial banks. That's why they are also regarded as bankers, indigenous bankers. Why? Because they are recording each and every transaction in the most systematic manner. But when you will discuss regarding the transaction or recording of the transactions by money lender, then the money lender might record the transaction, it might not record the transactions. But if the money lender is recording the transaction, then also it is not recording the transactions in the most systematic manner. He might be recording the transactions in a simple manner, in a simple passbook, or in a simple, you can say, handbook, on a simple plane of paper. That means recording is not done. If it is done, then it is not done in a proper manner. Now, in the next video, we will discuss regarding the various sub-markets of the money market. In the next video, I will discuss with all of you regarding what is the meaning of sub-market, what are the important features which are concerned with sub-market, what is the concept and feature of CPs, that means commercial papers, what is the meaning and feature of CDs, that means certificate of deposits, what is the meaning and feature of CBs, that means commercial bills, what is the meaning and features of government securities. So, thank you for watching this video.